Thanks for joining our apartment end of quarter review here today. We've got a couple operating points that we want to cover, go over the performance of some deals specifically. And again, we always have a full write-up in any of our investment cover pages. So if you have those, you can see all the details of what's happening on each specific property. So we're going to dive into our operating metrics that we go through each quarter now and really take a look at how we're seeing our performance, how that compares to what the market's showing right now.
Yeah, so we'll start with operating return on assets, our new term, ORA.
Yeah, we've been working on this one for a while of trying to find what we think is an easy way to compare all the asset classes and really see how is something performing and what kind of yield is it generating.
Yeah, a very common question we get asked from investors: hey, are apartments better to invest in versus industrial flex versus office versus mobile home parks? And this was our way to basically normalize the whole playing field and look at really all the assets on the same metrics.
Yeah. Yep. Yeah, we're really looking at how much yield is generating from the book value of assets that we have. So when we buy a deal and we invest capital improvement dollars, that gives us our overall basis, and what is that basis yielding? So when we look at some of the things out of the gates, we really want to just touch base on what is a good ORA number and an ORA chart look like, and what is one that's got some challenges ahead of it look like. So we got two charts here that you can see, and this really shows one deal that's performing well and one deal that we're facing some challenges on. All right, first thing you notice when you look at these two charts is one side, all the numbers are going up, right? So there's 4 lines on here, and they're all kind of growing. On the right side, we've got the yellow line, which is declining. And these show a couple different metrics. The gray line on the top is our revenue as a percent of the asset value. So here on the left, you can see we went from 14%, 15, 16, 17. We're seeing pretty consistent annual revenue growth. If you look on the right side to this property, you're seeing very similar growth, 23% to 29% over a 4-year period. And that property, for how much we paid for and our basis, has much higher revenue from our investment dollar.
Right. So chart on the left, we bought it, we renovated, put a lot of money into it. Our basis is higher. So we're seeing that revenue is a lower percentage of the asset versus the chart on the right. We put less money into it when we bought it. It was more stable. It was in an area that didn't have the same type of rental potential. And so our basis is lower there. So we're seeing a lot higher revenue on our equity.
And we look at these, we're specifically not talking about the property names because the data is really what shows us how these things are performing, right? So the one on the right, the challenges that we start facing, you can see this over the past 2 years, is that our operating return on assets, which is the orange line that you see here, includes debt pay down. It's essentially how much free cash is generated, has started to decline. So whether it's insurance costs or operating wages are too high or repairs and maintenance or whatever it is, you can see that it's starting to decline. Whereas on the property on the left, it's steadily improving year over year. And what that ultimately yields is our return on equity, right? So we're in the business of trying to generate as much passive investment income as we can for our investors. And to do that, it requires positive return on equity. On the left side, we see a continually growing return on equity. And this is a deal that we consistently want to hold because we see expanding margins and continued growth. On the right-hand side, we see a pretty opposite picture. You see return on equity that has gone negative, meaning this asset is no longer able to cover its operating expenses. It's not able to produce a positive return just from the state that it's currently in. Occasionally, we'll see dips, right? Sometimes you have tough years and a roof needs to be replaced or something happens. But once you start seeing a longer trend, that's when we look at a deal and say, is there a way we can turn this thing around? Is there a way that we can grow revenue exponentially higher? Is there a way we can cut back on costs and ultimately improve our operating return on assets and ultimately our return on equity? If we can't do that, then we'll look to sell the non-performing deal.
Yeah, so we look at these charts every quarter, review them every quarter. We actually review them monthly with our teams, and the entire company is really bonused and promoted based on the performance of each one of these charts. And that goes not only from the maintenance and the leasing team and the property management team that's physically on the property, but also has to do with our entire office team, our accountants, our investor relations, et cetera, are all tied to this bonus structure.
For us, it's a great way to just keep tabs on how things are going and what's working and what's not working, right? So that's just an example of how we're using Aura really on an all-the-time basis to assess our property's performance. Now, the deal on the right that was declining, that was a property called Kingstown that we own. We've owned it for quite a few years. We've tried a few things there. We recently tried renovating units. If you had any of the other old investment reports, we talked about doing upgrades to the units there and getting higher rents. Ultimately, right now, that has not been working. We've not been able to get rents high enough to generate positive cash flow. So we're seeing significant expense growth there, really on the tax side. We're seeing significant growth on the tax side there, and each deal has unique circumstances of what's happening there, and that one's impacting that deal the most. And we were not able to raise rents high enough to cover those tax increases, which is why we're seeing our negative operating return. Right. Okay, let's shift gears, and we are going to go into our performance metrics, and this is really the operating details of how the portfolio is performing, and we'll call out a couple properties and just kind of how they're working. But our favorite number to talk about is retention. This has been our staple for 10 years that we've been going through it.
Well, when we first got into the apartment industry, the general retention number was 50%. And we said, man, we feel like we can do better. Like, why is it only 50%? We if we're doing good work, we have good residents, why shouldn't they stay with us longer than, every other resident leaving? So our focus in the business shifted very quickly as they listen, our goal is to keep these residents in the property, get more nominal increases, but save money on the turnover cost.
Yeah, and really the higher retention, that's exactly what that accomplishes, right? And that's how we track how we're doing in that metric. And this quarter we hit 72%, which we're very excited about. Over 70% is really our target, but also it's a stretch target every quarter. When we hit 70%, it is excellent. We feel like we're firing on all cylinders and things are really working very well on the operating side of the business. So 72%, solid numbers for the quarter. Very excited about that.
And that ultimately means that because we're spending so much less money on turnover, we can spend more money on the existing residents that are staying there, but also we can invest more in the few units that are turning over and get higher rental increases on those. So what we generally see is on renewal increases, we're getting 3 to 5% increases. But on turning units, we're getting more like 15 to 20% increases. Yeah,
and that's a good segue to kind of talk about our revenue growth and what we saw this quarter versus over the year. So first quarter of 2024 compared to the first quarter of 2023, saw 7.5% revenue increase across the board. The majority of that was rent. It wasn't other fee income and stuff that was generated. So fee income makes up only 1% of our revenue. So this was added rents that were there. So that was very positive that we saw, but that's a decline over the past really 2 or 3 years, where it used to be around 10% is what was pretty commonly seen. We look at the first quarter compared to the fourth quarter of 2023, and we're seeing a 1.5% increase, which translates to about a forecast of 6% for the year. And again, 6% is lower than what we saw in the trend last year, and now we're coming off kind of the highs of that 10% plus annual revenue gain rate that we had before.
Right. But, compared to national averages, we're still very much ahead of trend there. When most of the nation's forecasting flat to slightly negative rent growth, even Atlanta's forecasting basically flat rent growth, we're pretty excited to see still significantly positive rent growth.
Yeah, it's good position. Right. And a lot of that we think, or what we believe, is that it's attributed to our retention rates. So we're able to do that stuff and reinvest in the properties and see that revenue growth really outpace what's in the market. Right. Generally speaking, Atlanta, when we look at what's going to happen going forward, Atlanta didn't see like a insane overbuilding of apartments kind of in this cycle right now. Other cities, when we look at like the Fannie Mae reports, because they've got really good data just on how things are playing out, especially from a delivery standpoint in the industry. On the apartment side, cities like Austin or Jacksonville, they had a lot of deliveries. So they're projected to have a harder near-term future, right? So they're going to probably see some rental drops there. Not just flat, but like they'll see some declines, and their occupancies are in the 80s. So they're trending quite a bit lower than high 90s where we're at right now.
Right. And it was interesting also, as you continue to read that report, the contrary cities, which didn't see a glut of new supply, like Cincinnati and St. Louis and Kansas City, they're still seeing positive rent growth because they're supply constrained. So it's pretty interesting to see the kind of supply demand balance come to fruition right now.
And on top of that, look at the past 3 years of apartments that came to market, right? And they're projecting just over 700,000 this year.
Right, compared to 500,000 last year and 475 the year before that. 736,000 is what they're planning on delivered for 2024.
Yeah, so a lot of new supply coming on, and that's at least the plan for 2024, and see if it all happens. But we also, one of the interesting statistics in here, and we face this a lot, and it's painful, and it's always a challenge.
Eats us alive.
Yeah, and you kind of feel like you should be able to control stuff, but you can't always. But the surveys in this and the new deliveries that are coming to market said 85% of developers were seeing delays in their projects specifically due to permitting. So it's a challenge right now that we definitely face. And if we want to get something done, the permitting process is lengthy. It just is. That just is what it is right now. To get around that stuff, we're trying to be as proactive and as involved with the municipalities as possible and providing them as much information to make it as easy as we can to get things approved and moved through the process flow, and kind of being there in the office, in the permitting office, that is, not our office, but in the permitting office to help move things along. So it's a very active effort to get that done, and that continues to be more and more of a functional responsibility that has to happen in any management business.
Yeah, one of the more entertaining stories is one of the municipalities we work with has a monthly meeting to approve permits, pretty common. And we applied for our permits 60 days ago, and the meeting was called and nobody showed up. So we get a notice the next day saying, hey, nobody showed up. So we're talking about the city officials that are paid to show up to approve did not show up. So they rescheduled it 30 days later, and 30 days later, nobody showed up again.
Yeah, so it pushes us out sometimes 60, 90 days to get stuff just approved. So, there's some challenges out there in operating right now that are not going to go away in the near term, right?
Right.
So that's what we're seeing on performance metrics. Overall is a very solid quarter. Anytime we hit that over 70% retention number, it's going to look pretty good. Helps with our revenue growth, and then ultimately leads into our distribution conversation. That's going. On the apartment side, we're looking for deals that stably distribute cash flow. We haven't bought a new apartment in a while, and if a deal can't continue to hit its numbers and continue to improve, we're probably not going to hold it for very much longer. But on this side, the majority of our deals made their distributions for the quarter, so we're excited about that. They performed well, and remember 2-3 years ago now, we significantly increased the amount of reserves we're holding on a property-by-property level. So we have much higher reserve thresholds that we're targeting. So not only are we making distributions, but we have good cash positions on each asset.
Yeah, and it's an important thing to clarify that even though a property is not making a distribution, for example, CityView, which we can talk through some of the details on that one. CityView is very much cash flow positive. It's earning money. It's doing actually very well. It's just we've stepped up its reserve thresholds as expenses and property taxes and insurance have gone higher. We basically have cushioned ourselves a little bit more. So reserve thresholds have gone up by 10, 15, 20%. So we have to accumulate that much more cash on the balance sheet before we distribute to anyone.
Yeah. CityView here, we're not making a distribution in this quarter, and that's one of the ones we wanted to talk about and go through why we're not and what do the numbers look like. Really, over the past 3 years, you can see positive numbers. It has a positive operating return on assets, a positive return on equity, continued revenue growth, and you'll notice that the revenue growth numbers that are in here were in the high teens, right? So that means that the revenue as a percentage of the asset is lower than some of ours. So we think there's pretty good revenue gains still to be had here on this property. And with a positive situation and a good prospect for revenue gains, that's why we want to keep this property. Mm-hmm. So we're holding it, even though it didn't make a distribution this quarter. We feel like it's in a good financial shape for continued growth. Exactly. Next, we're going to jump into potential transactions. That's a question we frequently get. right? Like, hey, what's on the horizon? Were you looking to sell anything? As you kind of people are in situations trying to prepare what they want to do with their capital and how it's working. Right now, the main thing we're looking at is we have 2 deals that are not quite hitting the operating return on asset numbers we want to see. That one we just touched base on the front here, Kingstown, that is one we're actually looking to exit right now. So, and as others, if they come up and they're not going to be able to hit these numbers and we don't have a way that, we're going to try. We love solving problems and going through it, and we're going to try to do different things to turn numbers around if we see drops. But ultimately, if we can't, that's when we're going to look to exit opportunity.
And overall, because of financing, market supply, meaning that properties that people are listing on the market to sell, is pretty constrained. So values are actually holding fairly well because there's such little supply going on the market.
Yeah. Yeah. So we feel like the market is in a strong position overall, even with higher rates. We haven't seen a big drop in pricing on anything. Right. So, last part, let's touch base on Barnes too. That's an exciting one from a
Barnes has been a
development standpoint.
Yeah, so we started the redevelopment. The first step in the redevelopment process is you meet with the city. You talk about really what they want to see. What do we want to see?
Start the permitting process.
And really start the process of what the steps we should take next. And for Barnes specifically, the next step was to do a rezone. And so it's currently 16 mobile homes. It's zoned for 28 mobile homes. And we have been proposing a 44-unit townhome development for the property, and also to fill in the septic pond and tie into city sewer. It's really the biggest changes. So we are on our 4th city hearing tonight, and we hope to get approved for the rezone. It seems like everything's in our favor. So once we get that, we can start really what's next, which is evaluate the new value of the property with the rezone, and then move forward with the permitting process to build 44 townhomes.
Yeah, it's going to be an exciting project. Right? These are affordable units. I mean, there's no like tax incentives or nothing like that, but we're trying to build an affordable product that one can live in.
Yeah,
have to be a good quality.
That fits the community well, that really services the community, also services, the property that we own.
Yeah. So we'll have more details on the Barnes deal as we go through the engineering and the drawings to see what we can get there and see how really cool we can make this thing look and really improve the asset that we have.
Yeah, and design-wise, these are built to rent townhomes. So give or take 950 to 1050 square foot, 2-bedroom, 2 baths. And the goal would be to get around give or take $1 a square foot in rent.
So, all right, that is everything we have for the first quarter here. Overall, we're very pleased with it. We have some good operating metrics that are showing smoothness in the assets that we own that are holding up and operating pretty well. So if you have any questions, please let us know. We'd love to talk more. And yeah, that's it. We're going to get back to work for a little bit here now.
Yeah.